Well, investors have been losing confidence in financial markets over the past few years. Events like the May 20 flash crash, the failed BATS IPO, and the Facebook IPO fiasco have frustrated investors, leaving them wondering what is going on. Well, many on Wall Street have been debating whether or not high-frequency trading is the culprit. That's when computers are programmed using complex algorithms to execute trades at microsecond time intervals. Joe Saluzzi, the co-founder of Famous Trading and co-author of a new book called Broken Markets, points the finger at high-frequency trading, and he describes the factors he thinks are harming the traditional retail and institutional investor.
Most volume that you see nowadays on the stock market is not being done by retail and institutional investors. It's a machine-based trading, which people refer to as high-frequency trading. These machines aren't necessarily, they don't care about what goes on in a particular stock, who the company's CEO is or what the earnings are. It's all about trying to get a hold of that order flow and take advantage of it. So if you're a regular retail investor, you're kind of playing their game. And particularly retail investors who use market orders, that's not really a good idea because those orders tend to get intercepted along the way. The flash crash was a great example of market orders gone awry. But the problem is that most institutional investors, which are the larger fish out there, the ones who are representing the 401ks and the traditional firms, they're losing out because the HFTs are seeing their order flow or able to model their order flow and take advantage of it. Just think about it as somebody jumping in between every trade, siphoning off a little profit and then moving on.
So do you think we can no longer interpret market moves as an indication of investor sentiment?
Partly during the day, prices are being, let's say, distorted by some of this type of trading. And one good example of how prices get distorted is nowadays exchanges will offer rebates for these high-frequency traders and other people, other brokers and participants to trade on their machines or to trade on their exchange. The rebate is a way of distorting a price. So what they do is you can trade stock and essentially buy it for, let's just say $7, and then you can sell that same stock for $7, but you can collect money on both sides with these considered rebates. You really didn't make a trading profit, but you collected rebates, which is a very distortive process, which is why the volumes go up, but what they call liquidity is not going up.
Do you think that the recent Facebook IPO fiasco was a result of high-frequency trading? What role did it play in that?
In the Facebook IPO, the technology basically wasn't there to handle the order flow. And you have to wonder, well, what's going on at the exchanges if they can't even get a company to go public without a hiccup? That's their main job, really.
On that point of the markets, you say that the markets are no longer functioning in their original purpose, and that is to help companies list, to help companies raise capital, and to help get investors involved in that process. Why do you say that?
Well, part of it is exactly the economics of the traditional Wall Street model are no longer there. In other words, back in the day, they used to be small research firms or small broker-dealers who would take companies public. They would help with the research and the roadshows and so on and distribute that research to institutional investors. Many of these companies are now out of business because the spreads, as they call them, the difference between the bid and the offer, has shrunk down to a penny. But it's not real liquidity moving that spread. So what happens is these people, the traditional brokers can't make money. They left the business. These IPOs are now having a hard time coming out to the market. If companies can't go public, they can't expand, they can't create jobs. And it's not just regulations like Sarbanes-Oxley that people point to. It's the actual structure of the stock market that is now hurting these companies on their way to go public.